Welcome to our introduction to the least squares moving average. The least squares moving average, or LSMA, combines the concept of moving averages with linear regression techniques. Unlike simple moving averages that give equal weight to all data points, LSMA fits a regression line to the price data. This regression-based approach creates a smoother indicator that responds more quickly to price changes, reducing lag. LSMA offers several key benefits over traditional moving averages, including reduced lag and smoother indicator values. LSMA is particularly valuable for identifying market trends and potential reversal points in trading, enabling traders to make more informed decisions. To summarize, the least squares moving average combines the benefits of moving averages with regression analysis, providing traders with a powerful tool for technical analysis. The least squares moving average is fundamentally based on linear regression mathematics. The core formula is y equals mx plus b. In this formula, y represents the price value we're trying to predict. X is the time period, m is the slope, which indicates the rate of price change, and b is the y-intercept, representing the base price level. To understand the least squares moving average, let's visualize some price data. Each point represents a price at a specific time. The least squares moving average calculates the line of best fit through these price points. This line minimizes the sum of squared distances between the actual prices and the regression line. Mathematically, we're minimizing the sum of squared residuals, which is represented by this formula. By solving this minimization problem, we find the optimal values for m and b. Now let's compare the least squares moving average to traditional moving averages by looking at how they behave with price data. A traditional moving average simply calculates the average of past prices over a specified period. It follows price action, but lags behind because it only considers historical values. In contrast, the least squares moving average projects where prices should be based on the trend. It calculates the line of best fit and extends that trend, making it more responsive to directional changes. Let's highlight the key differences between LSMA and traditional moving averages. LSMA projects the trend direction rather than simply averaging past values. It minimizes noise in the trend and responds faster to direction changes. Let's walk through the process of calculating a least squares moving average in trading. We'll use this sample price data to demonstrate each step in the LSMA calculation process. Step 1. Select your time period. For our example, we'll use a 14-day LSMA. This means we'll analyze 14 days of price data for each calculation point. Step 2. Apply linear regression to our selected time period. Linear regression finds the best fitting straight line through our price data. This line minimizes the sum of squared distances between the line and each price point, hence the name least squares. Step 3. Calculate the endpoint of our regression line. The final point on our regression line becomes our first LSMA value. Step 4. Repeat this process by sliding our window forward and plot each endpoint to form the LSMA line. As we move our 14-day window forward, we calculate a new regression line and find its endpoint. Repeating this process for each period and connecting these points creates our complete LSMA line. To summarize the LSMA calculation process, first, select your time period. Next, calculate regression lines for each time window. Then, plot the endpoint of each regression line. Finally, connect these points to form your LSMA line. The resulting LSMA line provides a smoother trend indicator that responds more quickly to price changes than traditional moving averages. Let's compare the least squares moving average with traditional moving averages. First, let's look at a typical price chart with some volatility. The simple moving average, or SMA, calculates the arithmetic mean of prices over a specific period. Notice how the SMA significantly lags behind price movements due to its equal weighting of all periods. The exponential moving average, or EMA, gives more weight to recent prices, reducing lag compared to SMA. The EMA applies exponentially decreasing weights, giving much more importance to recent prices than older ones. Now let's add the least squares moving average, or LSMA, which uses linear regression to find the best fitting line through price data. Let's zoom in on a section to better see the differences between these moving averages. When we look more closely, we can see how LSMA responds faster to price changes than SMA, with less lag. The SMA exhibits significant lag, while the LSMA stays closer to the actual price trend. This makes LSMA more responsive to recent price changes. While EMA gives more weight to recent prices, LSMA considers the overall trend direction, creating smoother lines that better represent the actual trend. Let's summarize the key differences between these moving averages. LSMA offers the best balance of low lag, moderate smoothness, and excellent trend direction identification. In conclusion, LSMA responds faster to price changes than SMA, creates smoother trend lines than EMA, and better identifies the actual trend direction, making it more effective for trend identification in most market conditions. Setting up the least squares moving average indicator on your trading platform is straightforward once you understand the key parameters. In MetaTrader, you can add the LSMA indicator by navigating to the Indicators menu under the Navigator panel and selecting Trend Indicators. If LSMA isn't available by default, you may need to import a custom indicator script. The primary parameter to adjust is the period length. A standard 20-period LSMA provides a responsive indicator that follows price movements closely. Increasing the period to 50 creates a smoother line that reduces noise but responds more slowly to price changes. On TradingView, adding the LSMA is simple. Search for LSMA in the Indicators panel or use the Pine script editor to create a custom version. TradingView offers a user-friendly interface for adjusting indicator settings. You can change the period length, price source, and even add an offset if needed. One important setting to consider is the price data source. While close is most common, you can also use HL2, high-low average, HLC3, typical price, or other combinations. On Thinkorswim, you can access LSMA through the Studies menu. You might need to use linear regma or add a custom script if LSMA isn't directly available. Many traders use multiple LSMA lines with different periods to identify trend direction and potential reversal points. A common setup includes a 20-period LSMA for short-term trends, a 50-period for medium-term, and a 200-period for identifying the long-term market direction. When setting up your LSMA indicator, understanding how the parameters affect sensitivity and reliability is crucial for optimal trading results. A shorter period like 10 creates a very responsive LSMA that closely follows price movements, but may generate more false signals. A longer period like 100 creates a smoother line that identifies major trends, but may lag behind significant price movements. Let's wrap up with some recommended LSMA settings based on your trading style. Remember that optimal settings vary by market, time frame, and trading strategy. Experiment with different parameters to find what works best for your approach. Let's examine 3 fundamental trading strategies using the least squares moving average. These include trend following, price crossovers, and multiple time frame analysis. The first strategy is trend following, which involves trading in the direction of the LSMA slope. When using the LSMA for trend following, we focus on the slope of the moving average line. An upward sloping LSMA indicates an uptrend, suggesting bullish conditions. When the LSMA is sloping upward, traders enter long positions to follow the uptrend. Conversely, a downward sloping LSMA indicates a downtrend, suggesting bearish conditions. When the LSMA is sloping downward, traders enter short positions or exit long positions. The key to trend following with LSMA is to align your trades with the slope direction and exit when the slope changes. The second strategy uses price crossovers with the LSMA line to generate trading signals. In this strategy, we focus on the points where price crosses above or below the LSMA line. Here's a price chart with the LSMA line. Initially, the price is below the LSMA line. When price crosses above the LSMA, it generates a buy signal. Conversely, when price crosses below the LSMA, it generates a sell signal. This crossover strategy is effective in trending markets and reduces lag compared to traditional moving average crossovers. The third strategy uses LSMA across multiple timeframes to confirm trading signals. Multiple timeframe analysis involves analyzing the same asset on different timeframes. The higher timeframe chart establishes the primary trend direction. The lower timeframe chart shows more detailed price action and helps time entries and exits. When both timeframes show an uptrend with LSMA, it provides a stronger confirmation for buy signals. The key is to trade in the direction of the higher timeframe trend, while using the lower timeframe to optimize entry and exit points. Let's summarize the 3 basic LSMA trading strategies we've covered. Each strategy offers different advantages and can be combined for more robust trading decisions. For best results, consider combining these strategies with proper risk management and thorough backtesting. Risk management is critical when trading with the least squares moving average. Risk management practice 1. Setting stop-loss orders. Risk management practice 2. Position sizing. Risk management practice 3. Avoiding overtrading. Risk management practice 4. Setting profit targets. First, setting appropriate stop-loss orders is crucial. When trading with LSMA, your stops should be placed at logical levels based on the LSMA position. In uptrends, place your stops below the LSMA line. In downtrends, place them above. This gives your trade room to breathe while still protecting your capital. The second practice is proper position sizing. Your position size should be calculated based on the distance to your stop loss. For example, if you're risking 1% of a $50,000 account, that's $500 per trade. With an entry price of $100 and a stop loss at $95, your position size would be 1 share. The third practice is avoiding overtrading. It's important to recognize when LSMA signals are unclear and avoid trading during these periods. When the LSMA line is flat or price action is choppy, signals become less reliable. Wait for clear directional bias before entering trades or reduce your position size significantly. The fourth practice is setting optimal profit targets. The LSMA can help determine where to take profits. A common approach is to set your first profit target at twice your risk, known as 2R. Additional targets can be set based on the distance to the next significant support or resistance level. Remember, even the most accurate LSMA signals require proper risk management to be profitable over time. Without these practices, even the best strategy will fail.